Okay, so we will get right into, I will move House File 4385. Are there any amendments? There's an A18 amendment, so that is my amendment?
Yeah.
Or is that somebody else's? So that would get in the, or the department would like. Okay, so I will move the A18-0764 amendment. Discussion. All in favor, say aye.
Aye.
Aye. Opposed? Motion prevails. We now have the bill in the order, in the shape that the author prefers. So with that, please state your name and who you represent for the record, please.
Good morning, Mr. Chairman and members. My name is Cynthia Bowerly. I'm the Commissioner of the Minnesota Department of Revenue. We are happy to be with you today, April 17th, which is tax filing deadline. For anyone who has not yet filed their taxes, you have until midnight to do so. Not looking at anyone in particular, Mr. Chairman, but just making that public service announcement for everyone's benefit.
Thank you very much.
So it's been a busy day already, Mr. Chairman. Before we get started talking about the governor's tax bill, I did want to take a moment to address the press release that was issued before this committee met regarding the incidence analysis that was issued yesterday by the department. I want to make clear that this analysis, as historically the incidence analysis comes from the Department of Revenue, lays out the implications of making any tax changes. When we have been discussing the governor's bill, we have been very clear that this raises no taxes on wage earners. It cuts taxes for over 2 million Minnesotans, and this analysis doesn't change or contradict any of that. There are changes, of course, to corporate rates, to corporate tax structures that under the incidence analysis are described to flow through to consumers. I think that is, I don't take any issue with the incidence analysis as it has been done historically in Minnesota. I would, however, note that as we're observing what is happening at the federal level with respect to corporate rates, the corporate rate cut that happened at the federal level is flowing largely to dividends for those shareholders, is not resulting in any changes to consumer prices, or largely to wages that individuals who are employed by those companies receive. And so I think when we consider the changes that are happening in the corporate proposals offered by the governor, it's important to consider what's happening at that federal level. And at the federal level, we don't see corporate tax cuts resulting in lower consumer prices. So I think it is an important question to ask whether any tax changes with respect to corporations, whether they would result in any increases for consumers as well. I'm just not sure whether that trend would go in both directions. So, Mr. Chairman, we'll be happy to answer any further questions on that. Overall, the governor's tax proposals with respect to responding to the federal bill are very progressive. The extension of the provider tax makes that on balance about neutral in terms of the current level of regressivity in our current tax code. Minnesota's tax code is slightly regressive, as is the case with most state tax systems. There is no state tax system that is progressive. And over the governor's 8 years in office, the bills that he has enacted have made our tax code much more progressive than they were when he took office. So, Mr. Chairman, we'd be happy to answer any further questions in response to that release that was issued this morning from your office.
Thank you. And I apologize for this, Commissioner, but I'm going to take a liberty here to find out. I have my list of testifiers. I'd like to know if there is anyone else that would like to be on the list for the Davids bill or with concerns. We have Nan Madden on here. Anyone else? I talked to Cap O'Rourke, so we're good there. Okay, just so I can kind of figure out the time here and so forth. Okay, so with that, to my bill.
Thank you, Mr. Chairman. Governor Dayton's tax bill continues his long-held commitment to tax fairness for hardworking Minnesotans while preserving a responsible, balanced budget for our state's future. The 2017 federal tax law, signed into law late last year, overwhelmingly favors big corporations and the richest Americans. The federal tax law cut taxes by 40% for corporations, totaling 92% of the net total cost of the bill, or $1.35 trillion. Nearly 50% of the new individual federal tax cuts go to the richest Americans, those earning over $250,000. The governor and the legislature face an important choice about how Minnesota will respond to the federal bill. The decisions made this session will impact state taxes for Minnesota individuals, families, and businesses. If the legislature does nothing to respond to the 2017 tax law, individual state income taxes will increase by almost $60 million for over 300,000 Minnesota families. If the Minnesota legislature fully conforms or mechanically conforms to the federal law, individual state income taxes will increase over $425 million for over 870,000 Minnesotans. Governor Dayton's proposal takes a different approach. Minnesota families would see $319 million in tax relief, and over 200 million Minnesota families would see a tax cut. Mr. Chair and members, you will recall from the department's presentation in January that the federal tax law made many changes to tax rates and base provisions. We will not go through those in detail today. We assume you all remember in depth the presentation we shared with you then.
And I think that was February.
It was February when
Correct.
you all came back. Thank you, Mr. Chairman. What we do know is if we do nothing this session, Minnesotans will face a very complicated tax filing system next year. And so we are hopeful that we can work through the rest of session to come to an agreement around a proposal for responding to the federal tax bill. Governor Dayton's bill would protect hundreds of thousands of Minnesota families from state increases caused by the 2017 federal tax law. His plan would separate our state income tax system from the federal government. Okay.
And remember, you have that in your packet also.
Thank you, Mr. Chairman. I think we have our technology set now. The governor's plan would simplify and cut taxes by over $100 million for farmers and small businesses for their equipment expenses. And Governor Dayton's proposal would repeal the tax breaks enacted last year in the Minnesota legislature that have threatened the long-term stability of our state's budget. It would roll back tobacco breaks for big tobacco companies, huge property tax cuts for corporations, and estate tax cuts for the wealthiest Minnesotans. I'll give you a quick high-level summary of the governor's bill, and then we'll go into some detail. The governor's bill creates a new personal dependent tax credit for all Minnesotans. The governor's proposal would create a new non-refundable tax credit for individuals earning less than $140,000 and married tax filers earning less than $280,000 per year. The new tax credit will provide $60 in a non-refundable credit and will be available for over 1.9 million eligible Minnesotans. He expands the working family credit to families, particularly larger families, and allows it at younger age levels so that someone who is 21 years of age will be able to access the credit. The governor's proposal preserves important deductions that Minnesota families rely upon. The proposal will align many business changes to the federal tax law and provide for the same treatment of foreign income at the state level. And finally, it addresses the three provisions from last year's tax bill. Excuse me, Mr. Chairman. The federal tax law prioritized corporations and wealthy over working families. 92% of the net cost of the bill went to a 40% reduction in the federal corporate rate. While cuts to the corporate rates were permanent, rate reductions and increased credits for individuals were temporary. The governor took a different approach and focused his bill on individuals and families across the state. The bill provides $319 million in tax relief to over 2 million families in Minnesota. This is consistent with the governor's approach over the past 7 years, during which he has offered hardworking families tax relief by proposing to expand the working family credit, the child dependent care credit, homestead credit refund, and the renter's credit. The bill provides a new $60 refundable credit for each individual on a return, and so a married couple with 2 children would receive a $240 reduction in their tax liability. Over 1.9 million taxpayers would benefit, And as you can see, the phase-outs are begin at $90,000 in income for individuals and reach those earning $140,000 or more. This will allow Minnesota families to help their budgets as we preserve the state's budget. The bill also expands the working family credit. Low and middle income families have been dealing with stagnant incomes and increasing costs of living. So this will provide 329,000 Minnesotans and their families an average of $160 tax cut. By expanding particularly this benefit increases the credit for families with 3 or more children. As you can see on the chart on the next page, it increases the amount of the credit and the income at which it phases out. Turning next to the proposals that specifically respond to the federal tax law changes. Minnesota faces an important choice when responding to the new federal tax law. As you all know, we start our code at this point with federal taxable income, which ties us to a number of provisions in federal law. And this may have made a lot of good sense about 30 years ago, but at this point, the governor is proposing that we move Minnesota to adjusted gross income as our starting point. This change will give Minnesota more control over our tax code moving forward and enable us to preserve the personal exemption at the state level, preventing a significant tax shift. The 2017 federal tax law enacted by President Trump and Republicans in Congress repealed or reduced many itemized deductions that Minnesotans rely upon. Governor Dayton's proposal would preserve those deductions for state taxes. Most significantly, the new law placed a cap on the federal, state, and local deduction, negatively impacting Minnesota taxpayers. To help stem the impact of those lost benefits, the governor's proposal would allow Minnesotans to continue to subtract the full amount of their Minnesota property taxes. And the governor's proposal would allow taxpayers to take the standard deduction at the federal level and itemized deductions at the state level. You can see here the list of some of the important benefits preserved by the governor's plan listed here. They include unreimbursed employee expenses, casualty losses, charitable donations, and others. Preserving these benefits will protect Minnesota families from unfair tax increases. For example, an employee who travels from different sites for their job does not get reimbursed by their employer, would get to keep their state tax exemption on those expenses. Under this plan, a worker that is required to travel from different sites would get to retain that deduction for their qualified expenses. Currently, about over 100,000 Minnesotans benefit from this deduction, saving an average of $419 annually. Under Governor Dayton's plan, a student or family that pays tuition for higher education and career training could continue to deduct those expenses at for their state taxes. About 27,000 Minnesota benefit from this deduction, saving an average of $96 annually. The property tax deduction is an important deduction for Minnesotans. The federal bill limits this itemized deduction for state and local taxes to $10,000. About 40,000 Minnesotans benefit from this deduction, saving an average of $500 annually. Under Governor Dayton's plan, homeowners would continue to be able to deduct mortgage insurance premiums for their qualified residents. Currently, about 70,000 homeowners see this tax break, averaging $94 annually. Under Governor Dayton's plan, workers who move to a new location for a job would still be able to deduct qualified moving expenses, and currently about 61,000 Minnesotans benefit from this subtraction, saving an average of $150 annually. And finally, charitable donation deductions are important to many charities and to many Minnesota families. The federal tax changes will result in fewer Minnesotans itemizing their charitable deductions. Under the governor's plan, Minnesotans would still be able to itemize their charitable deductions, their charitable contributions. A family that, for instance, donates $400 per year and takes the federal standard deduction but itemizes deductions from Minnesota could keep deducting that amount from their state taxes. And finally, Mr. Chairman, when hurricanes or tornadoes, wildfires and other natural disasters happen around the world, Minnesotans often give generously. Governor Dayton's proposal would match federal changes by removing the limits on the amounts Minnesotans can deduct from their state taxes for contributions for these disaster relief efforts. And finally, Mr. Chairman, I would note that the governor's proposal would allow taxpayers to take the standard deduction at the federal level and itemized deductions at the state level, which would prevent a tax increase of $59 million on 300,000 Minnesota families. Turning next to the proposal's response to the federal bill for businesses, there's significant tax relief in the governor's proposal, first by allowing full 179 expensing. The 2017 federal tax law allows businesses, especially small businesses and farmers, to quickly deduct their expenses on the equipment they need to grow their operations. Typically in Minnesota, we have had an 80% add back. The governor is proposing to allow the full treatment for 179 in his proposal. This would be the first time Minnesota would be in full conformity since 2005. Under the new law, Section 179 expensing election is modified to increase the maximum that may be deducted up to $1 million, up from $500,000 in the previous law. That dollar amount is reduced dollar for dollar to the extent that the total cost of 179 property placed in service exceeds $2.5 million, and this is up from $2 million under the previous law. Governor Dayton's proposal would also match the federal changes for a number of additional business provisions that would simplify record keeping and tax filing. For example, the governor's proposal includes conforming to a number of changes, most significantly allowing more businesses, especially pass-through businesses, to use different types of accounting methods to simplify filing and reduce their taxes. Next, the proposal would conform to the net interest deduction, which is now limited to 30% of income for larger businesses. Right now, state law allows businesses to deduct 100% of their interest, as did federal law in 2017. The new federal tax law changed the law for businesses, limiting the amount of interest that they can deduct, and the governor's proposal would conform to this part of new law and would also allow businesses with gross receipts of less than $25 million per year to continue to deduct the 100% of their interest, ensuring that smaller businesses can take advantage of additional tax benefits and more flexibility. The 2017 tax law limited the net operating loss deduction for a given year to 80% of taxable income, effective with losses beginning in year 2018. The governor's proposal would conform to this change while maintaining our state 15 years limitation on net operating loss carryforwards. And Mr. Chairman and members, with respect to the foreign income provisions that the federal law changed, the governor proposes conforming to those. The federal law imposed a one-time tax on businesses that have stored their profits on foreign subsidiaries overseas. Beginning in 2018, businesses will be allowed to bring that money back to the United States without paying an income tax for a limited period of time at a much lower tax rate. The governor's proposal would treat that income in the same way. This would allow for both all three types of income, that repatriated income, global intangible low tax income, foreign derived intangible income, to be treated in the same way. First, that they would be treated to the dividend received deduction, and then, of course, a portion to Minnesota pursuant to our single factor sales system. Thank you, Mr. Chairman. I'm now going to turn it over to Mr. Cummings to describe some additional changes in the tax bill.
Thank you, Commissioner. Please state your name, who you represent for the record, please.
Good morning, Mr. Chair and members. For the record, my name is Paul Cummings, and I'm the Tax Policy Manager at the Minnesota Department of Revenue. Mr. Chair, I'll start out with some business tax items that are in the bill, starting with Article 3. This is in the bill on page 54 and summarized on page 8 of the summary. Minnesota's Angel Tax Credit provides a 25% credit to investors or investment funds that put money into new technology startup companies. This initiative has helped over 345 Minnesota businesses in growing industries like software, biotechnology, and medical devices. It helps them secure needed startup capital. Governor Dayton's proposal would increase the Angel Tax Credit funding by $10 million for tax year 2018, allowing more investors to help build and expand new businesses and create jobs. As high-tech startups look outside the confines of the traditional hubs like Silicon Valley, Minnesota has the opportunity to provide incentives that will encourage job growth and technical expertise here in the state. The Angel Tax Credit Program has resulted in over $421 million in private investment in Minnesota startups, leveraged by the state's issuance of $101 million in tax credits to angel investors. Investment dollars raised with the Angel Tax Credit Program comes not just from Minnesota investors, but increasingly from non-Minnesotans, with over 50% of the investment dollars in 2007 coming from non-Minnesota investors. The program spurs economic growth and builds on Minnesota's existing ecosystem of high-tech, high-innovation companies. Mr. Chair, I'll move on to the corporate tax reform provisions in Article 4. They are in the bill on page 57 and summarized on page 8 of the summary. This is a grouping of proposals intended to make the tax system more fair, transparent, and equitable. The first is a proposal on preventing tax evasion. This restricts transactions or organizational structures that are structured only to avoid tax and do not serve a business purpose. This proposal includes a penalty for using transaction or organizational structures that are put together that only serve to avoid taxes. Second proposal deals with the base year percentage for the research and development credit. This proposal would allow taxpayers to use a 16% base year percentage for calculating their research and development credit when records are no longer available for those base years. The proposal intends to allow the credit even when a taxpayer cannot produce documentation to substantiate the base year activities for increasing research activities. Currently, when the base year records are not available, the credit can be disallowed because of lack of documentation. The third proposal deals with the apportionment sales factor and to exclude derivatives. This proposal would add a provision to specifically exclude derivative sales from the income apportionment computation. Currently, Minnesota does not have any statutes or methods that specifically address how to apportion this type of income. The dealing of derivatives is usually high volume, which skews the apportionment percentage of total income to be attributed to the state. The next proposal deals with mutual fund manager apportionment. Manager. This would require all entities that manage mutual funds to apportion their income consistently based on where the mutual fund shareholders are located. Under current law, a corporation that manages a mutual fund apportions its income based on where the shareholders are located. But if another type of entity, such as a partnership or LLC, manages a mutual fund, then its income is apportioned based on where the mutual fund is located. So taxpayers have set up organizational structures to exploit this inconsistency. The next proposal deals with the dividend received deduction on debt finance stock. This proposal excludes dividend received from debt finance stock when calculating the dividends received deduction. For instance, a corporation generates income and pays tax on that income. The remaining profit may be distributed to stock shareholders as dividends and is included in the shareholders' taxable income. Shareholders who are corporations are allowed a dividend received deduction of 70 or 80% of dividends received from another corporation to limit the amount of perceived double taxation on the income from the first corporation. When a shareholder is a corporation that purchased stock by incurring debt, the interest paid on that debt is allowed as an expense deduction. The interest expense is in addition to the dividend received deduction allowed on dividends received from debt finance stock. So, Mr. Chair, the net effect is that the interest expense allowed as a business deduction plus the dividend received deduction may exceed the amount of dividends received. So in this case, the taxpayer may report a net loss when actually net income is realized. This proposal excludes dividends received by holding debt finance stock from the dividend received deduction to prevent reporting a net loss when net income is realized. Mr. Chair, the next proposal deals with fairness in insurance taxes. This proposal matches the insurance premium tax rates for non-admitted surplus line policy, whether purchased directly through a broker or through a broker. A surplus line policy is the same no matter how it is purchased. But under current law, the tax on directly procured policies, which with a rate of 2%, is lower than the tax on policies purchased through an agent, which is at 3%. The taxpayers that benefit the most from this difference are large corporations with in-house insurance divisions available for direct procurement. The proposal would mean that about 35 Minnesota taxpayers that directly procure would pay 3% instead of 2%. About 1,600 are subject to the 3% rate currently under law. Mr. Chair, finally, the qualified data center sales tax exemption. This proposal limits the exemption to computer software that exclusively operates, maintains, or monitors the enterprise information technology equipment used at the data center, rather than all computer software generally qualifying. Enterprise information technology equipment is defined as computers and equipment supporting computing, networking, or data storage, including servers or routers. Some of examples of what would continue to qualify under this revised definition would include computer software that operates, maintains, or monitors technology equipment used for temperature control infrastructure, power infrastructure, for transformation and distribution or management of electricity, used for the maintenance and operation of a qualified data center. This exemption from sales tax was first enacted in 2011, at that time with refunds being paid beginning after July 1st of 2013. It was estimated to cost about $24 million in 2014 and about $4 million in 2015. This exemption was modified in 2013. Square footage requirements and investment thresholds were reduced and the qualification period extended. At this time, the changes to the exemption were estimated to cost approximately $8 million per year. The most recent tax expenditure report anticipated that the qualified data center exemption would cost about $70 million in fiscal year 2018. The most recent claims for this exemption include significant amounts for computer software. While the inclusion of software is not new, the amount claimed for refund has significantly increased. In December 2017 alone, refund claims exceeded $50 million, and about 55% of those claims were attributable to computer software. This exemption has grown well beyond its intended purpose, mainly due to the unexpected growth in claims surrounding computer software. Mr. Chair, if I could, I'd like to move on to Article 5, which is on page 71 of the bill and summarized on page 9 of the summary. This proposal deals with a change in tobacco products tax. Governor Dayton's proposal would crack down on tobacco tax evasion by some taxpayers, create fairness among those who sell similar tobacco products, standardize taxation of vapor products, and improve public health by reducing access to cheap tobacco, particularly among younger Minnesotans. This recommendation would reduce contraband tobacco products in Minnesota by standardizing the taxation of vapor products, creating a vapor products manufacturing license to change the current point of taxation, establishing a process whereby the Department of Revenue can revoke a retailer's cigarette or tobacco license. Beginning with moist snuff, it would require tax stamps to be placed on other tobacco products similar to the cigarette tax stamp. Expanding invoice retention requirements for cigarette and tobacco products, and establish civil penalties for violation of those requirements. Would increase the license fees for cigarette and tobacco distributors and subjobbers, effective for tax years beginning after December 31st, 2018. And would provide the Department of Revenue greater authority to refuse to issue or renew a distributor's subjobber license. From 2001 to 2017, cigarette use among high school students declined from 18.1% to 9.6%, an 8.5% drop. That was less pronounced for other tobacco products, which are not stamped and easier to bring into the state, resulting in much lower prices. By reducing the amount of contraband tobacco, the state can help reduce tobacco use by younger Minnesotans. In contrast to conventional tobacco products, the use of vapor products has increased drastically. In 2012, a national survey found that only 3% of high school students had smoked e-cigarettes in the past 30 days. But in Minnesota, that number jumped to 19% in 2017, and the Department of Health found that 38% of high school students have tried an e-cigarette. Part of the reason these vapor products are so accessible to younger audience is their very affordable price. Under current law, some businesses are able to pay the excise tax on nicotine, not the final vapor product, dramatically reducing their tax liability. The FDA issued regulations on vapor products in May of 2016. I wanted to talk a little bit about tobacco smuggling, Mr. Chair. Now, when I'm talking about tobacco smuggling, I'm not talking about cigarettes. Cigarettes are something that is stamped. In this instance, I'm talking about other tobacco products, which is sort of moist snuff and other types of tobacco products. From 2014 to 2016, the Department of Revenue conducted 3 of its largest seizures on contraband tobacco products. The seized cigars, moist snuff, and loose tobacco worth over $172,000. They were found in trucks, trailers, and storage units, often originating from out of state. These seizures likely represent just a fraction of the total smuggling activity occurring in Minnesota. They occurred mostly by chance during routine traffic stops or unrelated investigations by law enforcement. These seizures show that tobacco smuggling is not only well organized and lucrative, it can also be relatively easy. This proposal addresses these issues by making needed changes to outdated laws and increasing oversight. The proposal will help ensure that businesses which abide by tax laws are not hurt by bringing contraband into Minnesota. Finally, Mr. Chair, I just wanted to provide a note on vapor. In 2017, tobacco use by young Minnesotans increased for the first time in 17 years, driven by a 49% increase in teen use of e-cigarettes since 2014. According to the Minnesota Youth Tobacco Survey, 19.2% of high school students reported they used an e-cigarette in the last 30 days, and that's up by about 13%. New federal regulations from the FDA could dramatically alter the way certain vapor products are manufactured. FDA finalized a rule effective August 8th of 2016 to regulate all tobacco products. These rules deem all vapor products to be tobacco products. One of the provisions of these new federal rules is that manufacturers of vapor products will have to obtain FDA approval for each of the products they sell, which includes submitting detailed ingredient lists. This approval process is anticipated to dramatically curtail the number of vapor retailers acting as manufacturers. Instead, businesses will likely shift towards the larger Minnesota distributors that also act as manufacturers. The taxing structure this proposal creates will align with federal regulations, be more consistent for all taxpayers, and will provide clear guidance to the industry as well as the Department of Revenue. Mr. Chair, I wanted to move on to Article 6, which is in page 100 of the bill and summarized in page 16 of the summary. Older Minnesotans are often on limited incomes, and the cost of property taxes can cut into seniors' budgets. The Senior Citizens Property Tax Deferral Program provides tax savings to seniors who are having difficulty paying their homestead property taxes. The program limits the amount of property taxes that eligible seniors have to pay to just 3% of their total household incomes, saving eligible Minnesota seniors $1.2 million a year. Right now, in order to be eligible for the benefit, seniors have to own or occupy their homes for 15 years. Governor Dayton's proposal would reduce that requirement to just 5 years and move the application date from July 1st to November 1st, giving Minnesota seniors more time to access this important benefit. We are currently working with Representative Petersburg and Representative Daraskowski on a group of reforms to this program that we hope will increase participation. The governor also recommends allowing property owners to qualify for homestead classification by providing an individual tax identification number to an assessor. The Internal Revenue Service issues ITINs in lieu of a Social Security number for some individuals who are required to file a federal tax return and don't have a Social Security number. The current law prevents many taxpayers who own a home from receiving homestead status, even though they meet every other qualification. Residents without homestead status are taxed at a higher class rate and do not qualify for the homestead property tax refund. The intent of the homestead classification is to have homeowners share a smaller amount of the overall tax burden, since they bring value and stability to the city, school district, and county that they live in. And finally, before I turn it over back to the Commissioner, I wanted to present the Sustainable Forest Incentive Act Private Lands Timber Harvest Credit. That is in Article 7, which is page 112 of the bill and is summarized on page 16 of the summary. Mr. Chair, this was not as part of the original budget that was released in March. It was released, I believe, last week. And so it was released as an item within the governor's bill. As the governor is trying to think of ways to sort of help people, private landowners, bring timber to market, this was a solution that was put together to try and make more of that happen. This proposal allows individuals, trust, or estate owning at least 20 acres of land in Minnesota to claim a refundable credit from the Department of Natural Resources. The credit is $5 a cord of wood harvested from the landowner's land and sold to a timber mill in Minnesota. In the case of multiple owners of a parcel of land, only one of the owners can be paid the credit with a maximum credit of $5,000. So this program will cost about $8 million, and so this program will be allowed as long as it is available and extended until 2021.
Commissioner Bowerly?
Mr. Chairman, thank you. The final provisions of the governor's tax bill address repealing some of the three of the unaffordable items in last year's tax bill. The governor has proposed repealing these changes because they are unaffordable and unsustainable. Taken together, these three provisions will cost the state over $1.5 billion over the next 10 years. The governor's commitment to a sustainable budget for Minnesota has been unwavering. In 2011, when Governor Dayton took office, there was a $6.2 billion deficit and $1.9 billion owed to our school systems. With good fiscal management and sound budget policies, the governor has successfully turned our state's finances around. The three unaffordable tax cuts passed in 2017 will grow over time and jeopardize our long-term fiscal stability for the state. The first item is the state general levy. The 2017 bill repealed the inflator on the state general levy. This proposal would reinstate the levy, the inflator on the levy, beginning with taxes payable in 2019. The freeze to the levy amount over time disproportionately benefits large building owners the most. Over the next 10 years, the freeze to the state general levy will cost Minnesota over $1 billion in lost revenue. Similar to how local governments change their total levy amount each year, the inflator allows the state general levy to keep pace with the increased costs of public services. Local property taxes have increased at a much higher rate over time than the state general levy. Last year's bill also included a tax cut for businesses as a result of the exclusion of the first $100,000 in value. The governor is not proposing to repeal that change, which is worth over $500 million over 10 years for businesses, and benefits small businesses in greater proportion than removing the inflator. This proposal would reinstate the general levy inflator, which impacts commercial and industrial property as well as seasonal recreational property. By reinstating the inflator, we will improve our state's long-term economic well-being by putting the state's general property tax in line with local property taxes and reduce the likelihood of future deficits by allowing the state general levy to keep pace with the increased costs of public services. The next item is the estate tax subtraction. The governor's proposal would freeze the estate tax exclusion for estates of decedents dying after December 31st, 2018 at $2.4 million, the current amount of the exclusion. Prior to last year's bill, only about the wealthiest 1,000 estates in Minnesota had a potential liability for the Minnesota estate tax each year. Family farms and small businesses are already exempt from the estate tax up to $5 million when they pass their farms and businesses on to their heirs. Freezing the estate tax at its exemption at its current level will reduce the regressivity of the Minnesota's tax code and will save the state over $250 million in the next 10 years. Finally, the governor is proposing to reinstate the inflator and restore the premium cigar tax rate. The purpose of the 2013 enactment of the cigarette tax increase inflator was to make strategic investments in healthcare, education, jobs, and to reduce smoking in Minnesota, particularly among its youth. As Mr. Cummings has already explained, it has worked. Each year, more than 63,000 Minnesotans die from smoking-related illnesses, and smoking costs more than $3 billion in excess in healthcare costs. Since the increases took effect, smoking has declined, most notably among high school students. Elimination of the inflator on these taxes will make cigarettes and moist snuff more affordable for our youth who are more price sensitive. Mr. Chairman and members, thank you for their time today. Governor Dayton's tax bill will continue to focus on families, just as the governor has done throughout his term in office. The governor's tax bills in 2013 and 2014 have resulted in tax relief for over 2.3 million Minnesotans. This tax bill will provide $319 million in tax relief for over 2 million families across the state of Minnesota, and small businesses and farmers would see $186 million in tax cuts. The governor's tax bill will improve families' budgets across the state of Minnesota without risking the stability of the state's budget. Thank you, Mr. Chairman and members.
Well, thank you very much, Commissioner and Mr. Cummings.